In today's video, I'm going to be continuing analyzing some of the commodity giants to determine if they are buys to have some more safe holdings in this upcoming possible commodity bull market. Hey, my name is Tucker Kraus and welcome to my channel. In today's video, I'm going to be taking a look at Vale stock to determine if they are a buy. I'm first going to go over a quick introduction to their stock before going into the company, some of their growth prospects, dangers, and finally into some of their in-depth financials. So before we continue, make sure to smash that like button. Now, let's quickly hop into introduction to their stock.
Vale trades with the ticker symbol VALE at $21.49 per share as of close on June 16th, and they have a market cap of about $110 billion. They have a very low PE of 9.91, generally below the S&P 500 average and what it currently is, with a very high dividend of 5.35%.
Vale is one of the largest iron producers and one of the largest nickel producers in the entire world, and when ranked by revenue, they are the 5th largest mining company overall, again, in the entire world. To quickly touch on their most recent quarterly results, in Q1 2021, their revenue was higher than Q1 of 2020, but lower than Q4 2020. Though their net income in Q1 2021 was higher than both, that's largely due to expenses around their 2019 dam rupture, which I'll get into more in depth in just a second. To very quickly touch on ESG as well. Of course, they do all the usual stuff like limiting greenhouse gas emissions because they're in Brazil, lowering deforestation. But the main things I want to comment on, like I said earlier, is that they definitely have some issues with their dams, to put it mildly, as it's been causing severe, every time it happens, severe environmental and societal damage. So in 2019, on January 25th, they had a dam erupt that killed 270 people. And on November 5th, 2015, it had a dam erupt that killed 19 people. And that 2015 explosion was also the worst polluting and environmentally destructive dam disaster ever. So they really need to step up their game there. And I'll get into a little bit more in just a second about how this also, of course, harmed their financials beyond just being horrible events. If you're wondering why I cut like every time, it's because I didn't want to get anything wrong here. Onto their growth prospects very quickly. Of course, like always, commodities booming, that would help. And plus, because of how large they are relatively safe. Though, of course, with those dams, it's a little bit less safe than maybe Rio Tinto might be, at least from what I saw, but generally safe due to their size and diversity. Plus, they'll have an extra boost from the EV market growing due to their nickel production. And their dividend is a minimum payout of 30% of their adjusted EBITDA minus the sustaining investments from that adjusted EBITDA. What are sustaining investments to them? I'm not entirely sure, but it's a very high yield regardless, and they're still profitable, so that's good. And of course, they can also add bonus payments. Obviously, commodities failing, that hurts the company a lot, and recently we have been seeing things like lumber and copper pullback, though lumber doesn't really affect Vale, so it depends how you think these pullbacks are going to go, if they're temporary or more permanent. But also, China has been reducing some of their buying of commodities, and so that of course doesn't help because like Rio Tinto, Vale, a lot of their revenue comes from China, and Vale, though, does actually have some operations in China, which I don't really like. And I should note, with their dam ruptures in 2019 and 2015, they failed to be profitable in both those years, and they've spent over $12 billion in damages related to the 2019 dam rupture in 2019 and 2020 alone, and are going to be paying more in 2021. They, of course, also had decreased mineral reserves in 2020 compared to 2019, but that's normal, and the exhaustion dates are still very far away. And, of course, they also have the license to explore 4.48 million more hectares, aka 11 million acres.
So first up, they are pretty biased towards the ferrous minerals segment, which is iron and iron-related things. And out of this 80%, 85% of it is just plain old iron ore, with about 13% of it being iron ore pellets, with just a few miscellaneous things making up the last couple percent. So actually, out of the entire business segments, it means that 68.2% of the entire thing is just regular iron ore. Now, 12.5% of total revenue is just nickel, which is about 70% of this base metal section, with about the other 30% being copper. And that nickel does include some of the nickel mine byproducts, which are some platinum group metals and some gold and some silver, as well as some cobalt. Something I should note though is that 78% of their refined nickel sales were for applications beyond stainless steel, whereas the industry average is about 38%. So this shows that they are more biased towards things like batteries, which will help as EV markets continue to grow. Then we also see a tiny bit of coal here, and something to note about coal is they said this in their Q1 2021 report, on getting rid of their coal segments, and their coal segments are unprofitable, so that makes sense. And to quickly touch on their geographic segments, it is mostly China, which I'm not a fan of. And when you combine that with the rest of Asia, as well as Japan, we see it is overwhelmingly the Asian market. But again, the main problem here is I'm not a big fan of how large that is related to China. That's all. But other than that, they are well diversified across the rest of it. Right, so now we can see their revenue here, and it looks very similar to most other commodity companies. We can see very high in 2011, and of course if we had this extended in the early 2010s and late 2000s, before falling down to a bottom in the mid 2010s, and has been steadily increasing since then at a very decent rate. Now, earnings per share, they for the most part aren't pulling any shenanigans with their shares outstanding. It's been relatively similar, though we can see in 2018 they did something here, since its net income is higher than 2017 but has a lower earnings per share, but that's not too important. We can see 2011 versus 2012, we had a significant drop off, with it being with the company barely being profitable at all in 2013 and 2014 in both cases. 2016 through 2018 and as well as 2020, we saw it be decently profitable, though to be honest, it's kind of all over the place. Though with some projections going at it, it looks like 2021 will be fairly strong. And we can of course see that 2015 and 2019 were significantly negative, especially 2015, I should say, since that was when both the dam ruptures happened. So definitely don't want more dam ruptures to happen. So return on invested capital, you can see, is 20%, which is pretty good since that's significantly above their weighted average cost of capital. Their return on equity is fairly alright since it's just alongside the S&P 500 average. Their return on invested capital, for comparison, is slightly higher than Rio Tinto's, though Rio Tinto's return on equity was significantly higher. Now quickly onto net asset value. We can see total assets minus total liabilities divided by shares outstanding, and so we can see that they are trading significantly above this floor value, but again, like always, this is a floor value. This is what they need to be trading at minimum, and this isn't necessarily their intrinsic or fair value. So let's quickly hop into their intrinsic and fair value with a discounted free cash flow analysis. We can see here with their base discounted free cash flow, of course using the weighted average cost of capital, which in this case is 7.03%, as you can see right here, compared to just a base 7.5% discount rate, since weighted average cost of capital can vary just from even the day you're doing it. And so we can see here in both cases, though, with a current value of about $21 compared to in the low 40s, we can see in both cases Vale looks significantly undervalued. Let's quickly hop into the outro for some of my thoughts.
Overall, Vale looks pretty alright. Me personally, I'm probably going to wait till I also look at BHP, just so I have an in-depth look at some of the commodity giants, more than just that comparison and then Rio and Vale. Overall, compared to Rio and the surface level look at BHP I've taken, it looks like Vale is growing faster than some of these other commodity giants, though they're a bit weaker financially overall and a bit less stable. So they might just be a little bit more risky, but still look fairly safe relative to like a penny stock, of course. And if you're interested in nickel, maybe Norals could also be something to look at, which something I would also like to look at in the future. So maybe I'll do that in the future, but now I'm just rambling. Make sure to smash that like button if you enjoyed, and I will see you next time.